I'm Sandy Sporthout, Capital Connection, and your vice chair. With us today, I'm privileged to introduce someone who's been teaching me about state fiscal issues for decades, and I'm pleased to call a friend and colleague, Dr. Steve Lerch. You all know that he's the executive director of the Economic and Revenue Forecast Council. And he's previously worked as an economist and a researcher on public finance and healthcare issues, not only in the state but also in Congress. And he was with the Department of Revenue here as well, and he has worked with the private sector. So he's got a very broad background, and he's here to talk to us about the state revenue forecast. So welcome, Dr. Lerch.
Nothing like economists who can't seem to hold a job. That's really makes you really feel good, doesn't it? Let's see if I can do this without standing right in the middle. You can pull that mic over.
Yeah.
Okay. Am I out of most people's way? Okay, cool. So. We just did a forecast on Friday. Typically during long session we would do a forecast in March, but when the supplemental budget passed this time, there was a request that we move it up to February 20th, which we did. To the best of my knowledge, we will not be doing a March forecast, at least based on the legislation that's passed so far. Unless you guys know something different that's happened in the last few minutes. So basically, most of our forecasts for the last couple of years, really on the economic side, have been pretty consistent. When we did our November forecast, that was our previous forecast, one of the things that we noticed as a big change, that we noted as a big change, was the drop in oil prices. Well, in November, we did bring down oil prices in our forecast, not far enough. So in this forecast, yet again, not news to any of you, we dropped oil prices yet further. But other than that, a lot of the forecast looks pretty similar. A little stronger U.S. GDP last year and this year. A little bit stronger employment growth in Washington than we'd forecast in November. But a lot of those things looked a lot like what you would have seen in November. Probably the most important thing at this time of year was we did raise the revenue forecast a little bit over $200 million for this biennium and next. Yes, that's a lot of money, but those two biennium budget, the revenues total for that is about $69 billion. So as a fraction of that, this is a relatively small forecast. Oops. Getting carried away with myself. So we did have a little bit of new data. We did have now a first full year of 2014 GDP data. We had a little bit of an update in the forecast that we use for our U.S. GDP forecast. So that was up. A couple of new months of U.S. employment data that's been very, very strong. A couple of really good months of Washington employment data that were a little stronger than we expected in November, so all those things were certainly positive. And then let me just kind of mention a couple of some of the things that we monitor as we're looking at the forecast, as we're thinking about it. We like to keep track of this small business index, and this is all survey based, and I suspect a lot of you are familiar with this. But one of the things that we're seeing here, good news, is that small businesses in general have started to feel a little bit more confident, a little bit more optimistic about where sales are going, about where the economy is going. And hopefully, of course, we'd like to see that translate into more investment, more employment. This would be kind of the equivalent sort of measure of optimism, but on the consumer side. Again, survey-based. You can see anytime economists throw graphs up on the board and you see these shaded vertical areas, those are always recessions. You can see how long coming out of the last recession it took for consumers to start feeling more confident about where things were going, but that has been generally headed up. That's certainly good news, especially in a state like Washington, where about 45–50% of the general fund comes from retail sales tax. So consumers are not feeling good. Revenue growth is not going to be so great. So this is certainly positive. And if we go back to 2010 and we look at the average monthly employment gains every year in the U.S. and in Washington, what we see is they've gotten better and better and better. And so for last year, really some pretty darn strong employment gains, both in the state and nationally. Obviously, that's very, very good news. However, because you can't get economists to just be, give you unadulterated good news, we just can't be that happy. I do have to point out that there are a few things sort of hiding behind those jobs numbers that give us a little bit of pause. And this is one of them. This is going back a couple of recessions, looking at the number of folks who've been unemployed for 27 or more weeks. And what you see is kind of during and right after the last big recession, how high that number got. It's really come down. That's really good news. But the fact of the matter is that there are a lot of people out there who are unemployed still and have been unemployed for a while. And so while those jobs numbers are great and they're helping to bring these numbers down, one thing this means is that there's still not a lot of upward pressure on wages. And as long as wages are relatively stagnant, we're not going to see consumers going crazy, going out there buying things.
You have thousands of, I'm assuming that's thousands of people that are on the left that are unemployed.
Yeah, because this is U.S. data, sorry.
Okay. All right. I'll wait till you go.
Okay.
Sorry.
Now, and I guess I should have mentioned this. One of the things I just mentioned that wage growth has been relatively weak, but we're starting to see some signs that it's picking up. For example, Walmart and TJ Maxx both just announced that they would be raising wages that they're paying their employees. That, I think, and I realize that this is, from an employer perspective, rising wages is not such a great thing. On the one hand, it raises your costs, but as households have more money to spend, they're going to go out and spend that money. That is going to be good for getting the economy. One of the things that we are keeping track of, that we have some concerns about, is the housing market and housing construction activity. And while it's certainly come back, both in Washington and nationally, since the recession, it's still somewhat weak given population growth relative to sort of history, even if we kind of throw out the bubble right before the recession. Construction activity has been a little bit weak. Household formation has been weak. And a big reason for that really is that young people coming out of college especially, the unemployment rate for them has been particularly high. It's been hard to find a job, or it's been hard to find a job in the field that they're trained in. They're coming out of college and working in retail as opposed to maybe the field that they hope to get a job in. And they've got student debt, and those things all mean that it's tough to go out and rent that first apartment, buy furniture, all those things that come along with household formation that really have a positive impact on the economy. And we believe that that's one of the reasons why construction and the residential market has been a little bit weak. However, as the job market picks up, we also think that we're going to start to see formation of households pick up. Those people that are living with their parents, they don't want to live with their parents. Parents don't want them to live there. They want to get out of the house.
Get out of here.
And so we are cautiously optimistic about where housing is going. Ports, and exports. With the port slowdown, one of the questions I've gotten from a number of people is, have you seen impacts of the port slowdown in the data? And so far the answer is sort of. And I think there's a couple reasons for that. But let me just start with export data. So the blue bars excuse me, that's quarterly growth on a year-over-year basis in total Washington exports. Well, the biggest export from Washington State is in the transportation equipment category, mostly Boeing jets. They're pretty much unaffected by what goes on at the ports. So if we subtract the transportation equipment out, that gives us this green bar. And what you see is, and this is dollar value of goods being shipped out of Washington, what you see is in the fourth quarter of last year compared to the fourth quarter of 2013, the dollar value of everything other than Boeing jets did decrease. That growth came down. Over there on the sidebar, I've got some of the larger categories outside of transportation equipment. And what we saw in the fourth quarter was, in dollar terms, a little bit of growth in ag products, not really strong. You can see petroleum and coal products, big drop. Some of that, of course, is just the fact that oil prices are down, and so energy product prices are down as well. Electronics, a lot of which is instruments, up a little bit. Food products down. So we get kind of mixed information here about the impacts of the slowdown in the ports. But, and I don't have it in graphical terms here, but if you go out to the website for the Port of Seattle, they report volume of containers moving in and out of the ports of Seattle and Tacoma. And if you look at 20-foot equivalent containers, imports or exports, in January of this year, and you compare that to January of last year, that volume was down 15%. It was down about 4.5% in the fourth quarter compared to the fourth quarter of 2013. And so I think, especially if you look in volume terms, that's where you start to see those slowdowns in the port. There was a quote from the ports that it would take about 3 months to clear out the backlog, and then things would be back to normal. I think in terms of sort of the broader economy, it's tough to point out impacts because, for example, I was talking to a gentleman who's a hay farmer in eastern Washington. He was talking about hay sitting in the dock rotting, about not buying a tractor that he planned on buying, about not hiring one more person he planned on hiring. And so some of this is showing up as, oh, the economy would be stronger, it would be doing better if that activity had happened. It's hard to say directly where we see negative impacts from the port slowdown, but we know there have to be negative impacts. If this can get cleared up in 3 months, that's good news. But the point that was raised a little bit earlier, one of the questions is, how much do port customers say, well, this is not a reliable place to send products out or bring products in, and so long term, what sort of impact does that have on the ports? And I guess I'd have to say that really remains to be seen, but certainly a concern. This is looking at our US GDP forecast. As I mentioned, a little bit higher in 2014 than we had anticipated. And for this year, we're expecting slightly stronger growth, but not a lot of big changes there. This, as I mentioned earlier, the big change in the forecast, a big drop in gasoline prices and oil prices, that drives some of that lower price in gasoline. You might have noticed gasoline prices coming back up a little bit. Oil prices may be stabilizing. But one of the interesting things is, if you heard today, the most recent inflation statistics, national inflation statistics were released today, and for the month we had negative inflation, minus 0.7%, almost entirely because of the drop in energy prices. And that lower inflation has some impacts, obviously, on the forecast. When we do a revenue forecast, it's in nominal terms. If inflation is low, revenue growth is going to be slow. Nominal income growth is going to be slow. From a purchasing power perspective, that may not be that big a deal if you've got strong real growth. But when we forecast revenue, it's in terms of actual dollars, not adjusted for inflation.
Can you explain something to me?
Sure.
Forgive my ignorance, but if oil prices are dropping, why is that bad for the economy?
It's not bad for the Washington economy. It's good for the Washington economy. It's bad for the North Dakota economy. It's bad for the Texas economy because they've got energy production facilities. It's good for us because almost all the impact is going to be on consumers, and that's a positive impact. The one negative that stands out that a lot of people don't think about, and it's on the revenue forecasting side, is because we have a gross receipts tax, when oil prices go down, the tax collections from refineries go down and from gas stations go down because their gross receipts go down. But in terms of the economic impacts on Washington, it's totally positive. Now, one reason we may not get as much sort of bang for the buck, if you will, for a drop in gas prices is illustrated by this. And that is, over time, the U.S. economy has become more energy efficient. We need less energy to produce any given dollar of gross domestic product, and this is adjusted for inflation. And so that means that if we need less energy to produce the goods and services we're creating, then as gas prices and oil prices go down, yes, that's good news, but it doesn't have as big a positive impact now as it might have, say, 20 years ago.
So related to that, with the CAFE standards going in effect at the federal level for fuel efficiency and new cars having those standards, has there been any forecasting on this model over time on what those standards would do to our forecasting on oil prices and the impact on the economy?
Well, you would think, that it should be consistent with this and sort of lower our demand for, at least on a per person basis or per vehicle basis, our demand for oil and gasoline, which lower demand ought to help hold prices down.
But then it would also have the negative of lower B&O on gas stations and refineries.
Yeah. And so definitely when we do the revenue forecast, we include oil prices in there as a variable that's going to affect especially those two sectors, refineries and the retail gas stations. And so, that does put some downward pressure on that part of the revenue forecast, no doubt about it.
Steve, what impact did the president's veto of the Keystone Pipeline have on our energy dependence and so forth, if any?
There's a subject I really love to discuss. Well, a couple things. One is it's not like that oil is not getting out of there. It's just getting out of there on trains. So it is being sold. Now, that's really expensive oil to produce. And so right now, and I don't know this for a fact, but I would assume that production up there in oil sands, tar sands, is probably not going full bore. And I've heard different prices on what's the break even for the tar sands, what's the break even for horizontal drilling. I don't know what the right number is, but clearly those are all much less profitable at $50, $60 a barrel than they were at $80, $90, $100 a barrel. And the U.S. has really increased its supply of energy production over the last few years. So I'm not sure that there's much immediate impact. Now, if those oil sands, if that production really cranked up and they couldn't get it out of there, then potentially there could be some impact. But that wanders off into territory where I could get myself into some trouble. But I don't think short term there's much of an impact, which is not me saying it's not important. This is looking at our personal income forecast. Not much of a change since November, but the main point here would simply be it's going up, it's growing, that's good news. We continue to see the Washington economy doing better, which is certainly positive. Employment was a little stronger at the end of the year than we had forecast in November, so we did raise our forecast. To give you a sense of perspective, though, by the end of 2019, this forecast has about 1.4% more employees in Washington forecast than we did in November. So it's an increase. It's not a huge increase, but it's definitely positive. Last year was a very strong year for employment in Washington.
So here's my question about Washington. That you did this term. So you have 2007, I'm sure probably sure. So you have a population, I'm assuming that's 22,700,000 people there at the bottom.
Yeah, so, I mean, we're looking at, right now, a little bit over, 3 million non-farm employees in Washington.
How does that compare to, I don't know how to phrase this question, but population of the state has grown. So yeah, 2,000, 3 million people compared to, population. So percentage-wise, has there been much of a difference in previous recessions, I guess is my question, of the population?
So employment population, the ratio of employment to population has come down nationally. It's come down here, no question about that, during the recession for some of the obvious reasons. Lots of people lost their jobs and got laid off. Hiring basically ground to a halt. So we're still sort of trying to catch up. Yes, employment is back, above where it was before the recession, but it's not like, and I think this is your point, it's not like the economy or the population wasn't growing during that time period. So relative to the population, the fraction of the population that's employed is smaller now than it was, say, at the start of 2007, before the recession.
Do you distinguish where the jobs are coming back in the forecast? Do you look at that?
We do. We look at we look at sort of relatively broad sectors. So we're going to look at construction, we're going to look at manufacturing, and aerospace is a subset of that because it's important information. So we'll look at, in nerd talk, 3-digit, NAICS sectors, that level of industry. No, we don't go too much finer because the data gets a little squishy. But yeah, we absolutely do. We use some industry employment, construction being a good example of that, in some of our specific revenue forecasts. For example, construction sales tax, is strongly related to construction employment. So yes. Now, while employment has certainly been growing in Washington, we're well back above pre-recession levels. I think one of the interesting things is that those employment gains have not been spread sort of equally across the state. So the blue line there is looking at growth in the Seattle metro area, so that's King and Snohomish County. You can see that it's really grown very, very quickly. The Seattle metro area has the lowest unemployment rate of any metro area in the state. But if we take the rest of the state, all the rest of the counties, yeah, we're seeing employment growth, but not nearly as strong. So if you live in Seattle and you're looking at all those cranes and you're looking at all that construction activity and you're looking at all the hiring going on, that's not exactly representative of the entire state. We continue to see some growth in, as I said, in residential construction activity. So this is our housing permit forecast. Not a big change from November, really about the same. But we are showing some growth. We're expecting some growth. Not wildly optimistic, but definitely some growth. And then this is looking at revenue collections for our major tax sources. So this is sales, B&O, use tax, public utility tax, tobacco products taxes. Third quarter of last year, incredibly strong growth, unsustainably strong growth. Not surprisingly, we did see a bit of a slowdown in the fourth quarter, but we're seeing some pretty decent growth here. And this is looking at the sales tax. Of course, huge crash in consumer spending during the recession, but it's really come back. Construction's been a big contributor. Auto sales have been pretty good. That's a big contributor. Anybody who's bought a car knows you pay a lot of sales taxes on the car. So that's been a big contributor here. And then the B&O tax, which tends to be somewhat volatile. As I mentioned, the lower oil and gasoline prices will sort of tamp down some of the growth for refineries and gas stations going out, so that'll sort of hold this down, but we're seeing decent growth there in B&O collections. Real estate excise tax continues to be interesting and a bit of a challenge for us. We've been pretty close on the underlying trend in terms of residential sales, but what's been harder to forecast have been big commercial transactions. There's been a lot of big commercial transactions in King County mostly, in fact Seattle and Bellevue mostly, and they've tended to come in lumps. And we have raised the forecast a couple of different times. One of the things we're concerned about is at some point You can only sell these buildings, you can only flip them so many times in a given time period before it doesn't make any sense. So we do expect that to start to slow down. But we did raise the real estate excise tax forecast again a little bit this forecast. But Seattle does continue to be a place where institutional investors really want to be. A lot of money coming into the Seattle real estate market for industrial properties, office buildings, hotels, things like that. Now, one of the sort of strange things in the forecast this time, your basic property tax levy is limited in terms of its growth to the lesser of 1% or the inflation rate as calculated the second quarter of each year. Our forecast for this year shows that the inflation rate that's going to be applied to basic property tax is going to be 0.14%. So that means that going forward, well, let me just talk about what's here. So, this lower part here, that's going to be the property taxes on existing property. The little lavender bar above it, that's going to be the allowed growth based on either 1% or inflation, whichever is smaller. In 2015, that will be 0.14%. So that gives us a little bit of growth on the existing property. New construction is on top of that. And what the red bar up there shows is the difference between the actual property tax collections, and this is the state school levy. That's all this is. It's not everything else. It's not voter approved stuff. But the state school levy for next biennium would be $26.5 million higher if the inflation rate in the second quarter of this year was 1% instead of what it's going to be, which is 0.14%. Now, because it's going to be below that 1%, this is a permanent reduction in property tax revenues, because then you apply the growth factor every year to this lower base. It affects 3 of the 4 property tax payments next biennium, all 4 in the subsequent biennium. That's why you get the $36 million loss. So just because of the one quarter where we're going to have this very low inflation rate driven by declining energy prices, we're going to have a little bit of a reduction in property taxes.
Is that the case even with suppressed valuation rates that are now going up as a result of the pressure on availability?
Well, but keep in mind that the way this works, it's not on a per property basis. It's for an entire taxing district. And so this is just that provision just says that, for example, the school levy on existing property in total can only go up 1%. Now, within that, depending on what happens to valuations and how quickly the valuation of your house goes up compared to somebody else's house or some non-residential property, you may see.
But the collective is still 1%.
But the collective is still 1% or
yeah.
1.014% in this one. So, only one other recent example of where inflation was not 1%, where this sort of thing has happened, that was in 2009. We've been a little bit below on our cannabis revenues. We've got 2 full quarters of collections. We're a little bit under the actuals for the last quarter of last year. We still have a decent amount of growth built into this. Our operating assumption has been that we will be ramping up to about 25% of the marijuana market will be going into these recreational stores based on some of the work that the drug policy consultants who work for the Liquor Control Board did. I would emphasize, as I always do when I get to this slide, that there is a lot of uncertainty around these numbers. We don't have historical data because this was illegal until pretty recently, So
somebody has to ask, are you advocating for us to get out there and hit the bomb? Or and no, I don't. I'm clean, Gary. If you're not contesting
You'll be drug tested afterwards.
We just report what happens. We're not encouraging any particular behavior.
Your predecessor always used to ask us to go buy new cars.
I was going to say, here's your chance.
Or buy a house.
Or some
Well,
weed.
if you go to one of the recreational stores and you buy a new car, I'd just like to remind you that that combination has essential legal ramifications. So I don't want to be responsible for that.
Have you seen a correlating rise in brownie and Dorito sales?
Those are not subject to sales tax. Unless you put marijuana in them first. Then they're subject to sales tax.
Just saying.
Then they're no longer food. Now, depending on what the legislature does or doesn't do this session with marijuana legislation, that may cause us to have to sort of rethink this forecast. But, you know, again, this is a current law forecast, so we're not making any assumptions about what might happen during the session. So. And then this is just looking at, this is our total forecast, both the dedicated non-general fund share and the general fund share of the marijuana excise tax. So you can see on the slide, we did raise it a little bit compared to our November forecast because we've been a little bit under. But again, you know, this is a really tough one to forecast. It's not like having 20, 30 years of sales tax data. So that's our forecast change for the current biennium. So it's about $107 million increase. And there's a track record. The red bars are forecast reductions, the green forecast increases. This gray thing, that is a combination of what we call non-economic changes. So that's legislative changes, large audit payments, large refunds, things that aren't necessarily going to be tied to current economic activity. So yeah, there have been some changes, but they have been relatively small. And we've now been, you know, doing a forecast for this current biennium since February of 2012. That's the forecast changes for next biennium. Again, in context, $36 billion forecast, $129 million, not a big change. And then that's looking at, by fiscal year, those are the general fund growth rates that we're looking at. We think of 4.5%, give or take, as sort of historical average growth in the general fund on an annual basis. So that gives you some context there. We're around that most of those years, not all of them. And we always do optimistic and pessimistic scenarios. We also ask the Governor's Council of Economic Advisors to give us their forecast. We plug their economic forecast into the revenue model. For this current biennium, their median forecast would have produced a revenue forecast about 30 million lower than ours. And I think this is, you know, is an interesting point, is while we have raised the forecast a little bit, you know, that forecast had some growth in it. It has some growth in it. It is not a totally pessimistic forecast. And so basically what the Governor's Council folks are telling us is, you know, we'd be a little bit more pessimistic than you are. And for next biennium, if we look at the Governor's Council's forecast, they'd be down about 226 million below our forecast. Again, that's pretty darn close when we're talking about $36 billion, but I guess I would just emphasize that, you know, assuming the forecast is just going to keep going up and up and up and up is maybe a questionable assumption.
So Steve, how historically accurate is the Governor's Council and Economic Advisors?
That I'd have to go back and look at. I would tell you that up until a couple of years ago, they tended to be a little more pessimistic than the Forecast Council. That usually that was a negative number. And then we had several forecasts where it was within a couple $1 million, which was almost scary. But because we've been pretty close and they've been reasonably close to us, I think they've, you know, been pretty close. Now, the one period where nobody did a very good job was during the recession, where they were off, we were off. I didn't work here then. Just saying. Or someplace else. All right, so just to kind of wrap up, not a lot of big changes in our economic forecast, with the exception of oil prices. That's a big one. We continue to see sort of moderate growth in the U.S. and Washington economy. We continue to think that Washington will do a little better than the U.S. economy. We see slightly stronger employment growth here, slightly stronger personal income growth. We've been saying that for some time now. That has been true. So we continue to think that Washington will do a little better than the national economy. There are some things out there to worry about, and I probably should emphasize those a bit more. The Chinese economy has been slowing down. That's our #1 export partner. That gives us some concern. Japan's fourth quarter, positive GDP growth, but the couple quarters before were pretty ugly. Japan's economy not out of the woods. They're usually our second or third biggest export market for Washington goods. The Eurozone, despite the fact that the Greeks did sign a deal that extends their bailout agreement, Greece is still in trouble. The Eurozone is still unstable. Not a huge export market for Washington in general, but it's a big enough part of the world that if something goes south there, it's going to have an impact on the U.S. and Washington financial sectors, so that is a concern. So I do want to emphasize that, we've made some assumptions about all of those things. Should we turn out to have been slightly optimistic about those, that's going to bring the forecast down. The flip side of that is the labor market's been very, very strong. Job growth has been very, very strong. It's possible that we're under that. So there are some risks on either side of the forecast, and I probably should have highlighted this, but we're essentially assigning equal probabilities to those downside risks and upside risks right now when we look at our baseline forecast. So with that, I'd be happy to try to answer any questions.
One of the when I see Ross Hunter make his presentation about the budget and some of the other items that he's considered, how tight the budget is compared to where he thinks it should be. One of the comparisons he uses is personal income growth in the state of Washington compared to how much we spend on any variety of things. But he uses the personal income growth or personal income in the state of Washington as a sort of a benchmark against which he measures everything. And just a while ago, you showed on the real estate excise tax, you get a couple big transactions and it tends to skew the numbers. And it's like the Olympics, you have to throw out the highs and the lows. It seems to me that we've got a couple of anomalies in the personal income category here in the state of Washington. Does anyone take that into account? I mean, when Mr. Gates or some of the other successful folks, sell off a chunk of stock, or half a dozen guys, and we have a lot of billionaires. Those guys can skew the numbers all by themselves pretty quickly. Do you take that into account?
Right. We try to. We do get some information on some of the bonuses and stock options that people sort of generically get, not on a company by company basis, obviously. We do try to adjust some of the numbers for that and acknowledge that spending behavior out of very large bonuses or big increases in stock options might be different than spending out of somebody's weekly wages. So we do, when we do the sales tax forecast, we do try to adjust for that.
What's the length of the economic recovery that you see? Because it seems like not you, but it's predicted that this is a pretty long economic recovery. In just historical terms, recognizing you're working off of probably a much lower baseline since 2008. It's been 7 years since 2008. We're due for an economic downturn just historically.
So official. So there's a group called the National Bureau of Economic Research. It's sort of a economic research entity. They are the sort of official arbiters of when recessions start and end. So the last recession, according to them, ended in June of 2009. The longest economic expansion, using their definitions, that has occurred going back to the mid to late 1800s is 10 years. So as somebody pointed out to me the other day,
Not enough time starting with a recession.
since we don't have a recession in our forecast that goes out to 2019, that's essentially saying, yes, you're expecting an expansion as long as the longest one that's ever happened. And I guess a couple things that I would note about that. First of all, if you start looking at the economy, the U.S., or especially the Washington economy, where the recession here started a little later and ended a little later, there's several months after June of 2009 that have lots of data points that don't really look like the economy's in an expansion mode, that still look like a recession. So, yes, that's sort of the official end of the recession date, but I think in a lot of ways, effectively, it was later than that. And then the recovery was really very lame, very weak. And so it wasn't like the typical sort of recovery period where you had this big growth in personal income and employment. It really took a while for that to get going. And so for those reasons, I don't feel like I'm being completely crazy saying that I don't think we're going to have a recession going out to 2019. However, I think your point is a good one in terms of thinking about forecast risks. It's like, there is plenty of time to have another recession that would be consistent with lots and lots of historic data. So I would totally
For
agree
the
with
record, I
that.
didn't call you crazy, Steve.
So noted.
Okay, this is the last question.
The data you presented on the long-term unemployed, where it's been habitually high and it just doesn't seem to be coming down. That combined with the low workforce participation rate, what implications does that have in the long term in terms of being able to stoke a recovery? You mentioned that the recovery's been kind of flat. How do those two interact?
Right, so that's a really good point. So given the sort of age structure of the U.S. economy, one of the things that's pushing down that labor force participation rate, that employment to population ratio, whichever one of those you want to look at, is people who are, give or take, my age or slightly older, of which there are a lot. There's a lot of people in their, I hate to apply this to me, late 50s and early 60s that are retiring and will continue to retire.
We get to retire?
Yeah.
Or think about it. See, I'm not so convinced I'm going to be retiring anytime soon. But we have seen, we have
But you
seen
can think
more
about
people
it fondly
retiring,
occasionally.
and it's a big chunk of the economy. But one of the things that means is the labor force is not going to grow as quickly going forward as it has, and that's in our forecast. That's in almost anybody's forecast. And so, if we want to see sort of historic economic growth rates, and we've got below average labor force growth rates, we need to see productivity expand faster than it has, or expand as strongly as it has, in recent memory. But that's certainly going to be a drag on economic growth, and that's going to be, a national phenomenon here, but everywhere else too. The good news is the age structure of our economy doesn't look like Japan's, where demographically, they're just in deep trouble.
So that's all. Thanks, Steve.